Welcome, everybody. This is Axel Merk, the President and Chief Investment Officer of Merk Investments. And many of you are by now familiar with our chart books that we create on different segments of the market, the business cycle, the Federal Reserve. This one here is on the equity markets that kind of pulls together some of the other work we do with a special emphasis on the equity markets. Nick Rees leads that effort. He very much focuses on the facts, and then I take the liberty to read in between the lines. So I encourage everybody to listen to and read Nick's analysis, as I'm more a freelancer here, so to speak, and I'm not trying to discredit the work he does, but I'm trying to read in between the lines to give you a little bit of a taste of what I do with these sort of data. This chart here depicts the relative weight that historically equities have had versus bonds. And it's based on the Fed Z1 report. It's a very comprehensive, fancy report, but it can be thought of more simply as the total value of US equities divided by the total value of equities and fixed income. And so when somebody sells a stock, obviously there has to be a buyer. So it's not like you hear in the media often that people are quote unquote selling because there's always a buyer. But the relative value between stocks and bonds is changing over time. And so in this particular chart, when the line is the black line, the dotted line here is very low, and here look at the chart is inverted, then there have been particularly high equity valuations. That means equities relative to bonds were highly valued. And so if you go back to 2000 as the extreme example on this chart here, odds are that over the next 10-year period, the returns weren't so glamorous. And so indeed, the black line here depicts then what the returns over the next 10 years were. And that's why also the black line stops here in 2008, because we just don't have the data points for the 10 years. And so with that, it kind of suggests what the returns going forward will be. Now, in many ways, this is an autocorrelation exercise. It's not so much a predictive exercise. And so that's why this chart has to be taken with a grain of caution. That said, if one takes this chart at face value, it kind of suggests that over the next 10 years, returns in the equity markets are going to be rather meager. In this case, almost near zero. Now, by the way, the S&P returns here without dividends. But still, if history is any guide, obviously this doesn't mean we're going to have flat returns over the next 10 years per se. It means that we might have a bull market or a bear market, but when all is said and done, stocks might not move much. And so as we go through the charts on the following pages, we're trying to see whether we might be near the peak of the equity markets. And I'm suggesting you don't need to necessarily time the top. If you think that we're getting closer there, it is all right to take chips off the table. And by the way, when one talks about taking chips off the table, which of course everybody has to see in the context of their own asset allocation, keep in mind that stocks have been appreciating quite substantially. So a mere rebalancing might be worth considering. So this chart here shows the business cycle going back to the mid-90s. And the reason why that's relevant is that historically, the stock market performs far better during economic expansions than during recessions. Some people go as far as saying, hey, unless we have a recession, there is no need to worry about the stock market. There are a couple of caveats to that theory. One is 1987. We had what was called the crash. We did not have a recession at the time. The second one is that we do not know the start of a recession until often well into it, or maybe even well beyond it, or a bit beyond it, and with a revision of economic data. That said, it is worthwhile to look at where are we in the economic cycle, and leading economic indicators, which is one way of trying to see whether we're going to be heading into a recession, suggest that everything is dandy, that there's no recession on sight, and several other metrics show similar things. Here, there is a way of looking at earnings. Earnings historically during recessions don't do so well. It's one piece of the puzzle. I actually got a tad more cautious on the markets in recent days because of earnings. Now, if you read the text here, earnings reports have been just fine, but what I have noticed is the market hasn't been too kind to companies that have missed or not exceeded expectations. And when that happens, at least on a shorter term basis, in my experience, that means some caution may be warranted. Now, that says less over the longer term trend. Which after all, we've had a 9-year or so bull market now. But in the short term, that got me to be a tad more cautious. The backdrop globally matters. We've heard different things coming from the rest of the world. We obviously have the talk of tariffs coming around. And so Germany has been in the news for having its purchasing manager index come down. There's also been a metric out, that's the green line here. There's a metric out the other day that is based on economic wise guys, they actually call themselves wise guys, that have been more cautious. Now, I'd like to caution about these quote-unquote wise guys, because obviously anybody in Germany may be excused for being intimidated by our tweeter-in-chief. That doesn't necessarily mean that the European economy is going to go into recession anytime soon. Indeed, factory orders, I believe, were better than expected. And so keep in mind, any reading above 50 on the purchasing manager index in any of these countries is a positive. Now, we don't list all countries here. Some countries, including, I believe, Russia, was recently below 50. They're all still in expansion mode. That's the short of it here. And so if you strictly believe that as a necessary condition, you need to have here some of the purchasing manager indices go below 50. We are not there. Financial conditions. To me, that's relevant in many different ways. There are several different financial condition indicators. We show here the Chicago Fed National Financial Conditions Index, which I think is one of the better ones. The short of it is that it shows that financial conditions are easy, which means banks are willing to lend. That's highly relevant because a lot of people in my view, mistaken perception that whenever the S&P tanks, the Fed is going to run for the hill and print money and start bailing people out. Well, yeah, that might have happened in the aftermath of the financial crisis, and indeed, as late as, or as recent as early 2016, when the S&P had a significant downturn, the Fed talk came out far more dollishly. But if you take, for example, the short vol trade that quote-unquote blew up beginning of the year when many people had piled into shorting volatility and then that trade violently went into reverse, the Federal Reserve barely blinked. And the reason I believe, and the key here is you see in the financial conditions, if banks are not affected by the downturn in the S&P, the Federal Reserve does not particularly care. And that means that we should focus more on other things. Are inflationary pressures building? Is the Fed going to continue to march on? And indeed, this is not the Fed chart book. I encourage everybody to look at our Fed chart book. My view is that the Fed will continue to march on. And actually, I believe this economic expansion is going to die the same death a quote-unquote normal expansion dies, with the Federal Reserve raising interest rates until this economy tips over. And the reason they may have to do that is because inflationary pressures will gradually continue to rise even as the economy slows, be that because of tariffs or a few other things. And the Fed may have little choice than to look at the current data. They're not going to, I don't think, read the tea leaves and say all the bad things that could happen because of tariffs. Other countries might do that are far more trade dependent. The European Central Bank may be more tempted to do it. On the one hand, they're more trade dependent. On the other hand, the European Central Bank is more concerned about the so-called peripheral countries. They want to make sure that the spreads are tight and so forth, which means that the cost of borrowing for the weaker Eurozone countries is just fine. In the US, we don't have such concerns right now, and therefore I don't think the Fed is going to care about that. Here's a measure of market breadth that Nick has come up with. You can study the chart in more detail. The short of it is the market breadth appears just fine. So from that point of view, no particular alarm. market sentiment is not as extreme. So again, you can study that in more detail. Margin debt, there are different ways of looking at margin debt. In this particular chart, it shows there's little concern. Other people have pointed out that there is some concern with regard to margin debt. This is the sort of thing that when the market tips over, obviously the margin debt will matter more. I don't give too much credence to this chart. It's good to talk about, but I don't think it has much predictive value. Here we have two charts, one explaining what we see in the next one. The short of it is that when you have when things are more correlated, then problems might happen, right? And what this chart shows, and please read here the small print for the exact way that this is depicted, but the argument Nick makes here on this chart, and I would very much agree with that, is when volatility is low and correlation is actually not high, that's a warning sign, because that means that the opposite might soon happen. And so it's in this context that and the way that this particular index here is constructed, it takes some diving into, and so if you're interested, you can dive into a little bit more. Economic uncertainty index is there's still a wall of worry left to be climbed. This chart here comes from the roll blow up. We have quote unquote normal conditions, so to speak. Market has been moving higher. This is a reminder that the calendar returns of the S&P 500 are not stable when people tell you that, hey, market is supposed to go, quote unquote, up a certain number percentage point in the years. Keep also in mind that interest rates are much lower, but still market returns are historically quite volatile. And so on this checklist here, the main negative is the long-term valuation. And so depending on, and many other indicators are still reasonably positive. And again, I think all of this is in the context of what any investor's frame of reference is. Even if you're completely bullish, that doesn't mean you shouldn't rebalance. If your, say, stock portion of a portfolio has substantially outperformed, or conversely, if another segment of the market has underperformed, doesn't mean that you shouldn't rebalance. And so I let you read here Nick's conclusions. Again, I encourage you to read these as well. If you have a chance, please sign up for the quote-unquote premium service of our chart books to help support this sort of research, this sort of publications. And my take here, for example, will put behind a paywall in the future. And so if you want to have access to it, we encourage you to become a premium subscriber. That would be great. And of course, please don't forget to read our disclosure. So with that said, please browse around merkinvestments.com/research, look at our videos, and then of course, follow me on Twitter or on LinkedIn or whatever your favorite site is to consume news and information. Have a good day.